Hi folks, and welcome back to Meaningful Money. I'm here at lovely St Loy Cove, or beach really, rocky beach though. I can't move too much else I'll probably snap my ankle because it's pretty treacherous underfoot, but a nice spot, I'm sure you'll agree. Now, still talking about wrappers. These are the things that we put money in. So we've talked about ISAs and OICs and ICVCs and things like that. Today's topic is investment trusts. Now, an investment trust is very similar to an OIC, similar to a unit trust, in that it's a collective investment. So just like those other things, an investment trust is a vehicle whereby you pool your money with lots of other people so you can buy more things and thereby diversify, reduce your risk and reduce your cost as well usually. The difference between an investment trust though and the other types are, well, there's two or three differences. First thing to say about investment trusts is that they're not trusts at all, they're companies, which means they have a board of directors and a fund manager, and they have shares because they are a company. Now the biggest difference between investment trusts and OICs is that, remember the word OIC stands for open-ended investment company. Investment trusts are closed-ended. And all that means is that when they are set up, there is a finite number of shares created. And you can buy those when the fund is started, but after the fund is started there are no more shares created. So if you want into the trust then, you have to find somebody willing to sell you some shares. So an investment trust is just a company, so its shares are traded on the stock market just like the shares in M&S and Vodafone and things like that. But the whole purpose of an investment trust is to invest, hence the name. See, somebody was thinking when they came up with that one. So they're closed-ended. Unlike an OIC, where somebody new wants to invest, they just create more shares. With an investment trust, they're closed-ended. That can't happen. You can only buy into an investment trust if there's somebody else wanting to cash out. A couple of other differences. First thing to say is that the value of all the investments inside the trust, the investment trust, divided by the number of shares that are in existence, is what we call the net asset value of the investment trust. It's what, if you invest in that trust, that's what one of your shares will be worth, the net asset value, NAV. The amount of stuff held, invested in by the trust, divided by the numbers of shares is the net asset value. But unlike an OIC, what an investment trust can do, it can either trade at a premium or at a discount to the net asset value. Now why would that happen? Well, let's say this investment trust is hot property. The manager is doing really well. Well, the net asset value is just what it's worth, what the underlying investments are worth. But those shares might be in such demand because this manager is doing such a good job that the actual price of the investment trust shares is higher than what the underlying investments are worth. So therefore the shares are said to be trading at a premium. If maybe that manager has made some bad calls recently there may be not so many people wanting to buy and in fact people wanting to sell, well, the share price of the investment trust can go down, and we call that, if the value of the shares are less than the value of the underlying investments, we call that trading at a discount. Because an investment trust is essentially a company traded on the stock market, so its shares can go up or down. But where it is relative to the underlying investments, it's either at a premium or a discount. The other key difference between an investment trust and an OIC, a unit trust, is that it can borrow to invest, and we call that leverage. So an investment trust manager can, if he thinks he's found an absolutely brilliant investment to put his money in, he can borrow so that he can buy even more of that investment. What leverage does is it increases the risk, it can increase the returns, but it can also increase the downside, hence it increases the risk. So that's leverage. So the key differences are the fact that it can trade at a premium or a discount, that it can borrow really, and that it's closed-ended in structure. So that's what an investment trust is. As far as you, the investor, if you have money in an investment trust, then any income you make off it or any gains off it are taxed just like any other shares, essentially. So that's investment trusts. Now, it's sort of the end of at least the basics of investment, but I'm still going to be talking about wrappers, but going to move into the other big sort of group kind of wrappers, and that is pensions. a word that usually makes people fall asleep, but which are an incredibly important part of your financial planning. So pensions next time. Thanks for watching, and goodbye from St. Loy.